has the global recession arrived already, or do we have to wait until tomorrow? That's the question we're going to be asking ourselves here on Macro Money today after a very ugly showing in the wake of U.S. CPI inflation numbers. Welcome. This is Ilya Spivak, head of Global Macro here at tastylive. And if you're just waking up now, a quick recap. Yesterday, we talked about U.S. CPI and said there was but a narrow window in which the markets were going to like it. The expectation was it was going to go from the softish, let's say, 3% in June. That was an undershoot of the expectation then, to 3.3%. If it was going to be too hot, we posited, that would mean the Fed is going to have to do more, which wouldn't be good if you're a buyer of stock and generally risk on in your disposition. If the number was going to be really weak, it would suggest that the bulk of Fed tightening is really starting to hit, that the economy is turning, that recession risk is underpriced, and that wouldn't be good. But if you landed right near expectations, well, then everybody could have their cake and eat it too, because you'd be just right to not nudge the Fed without spooking growth concerns. Well, turns out that was too optimistic. We got the number, and it came Goldilocks perfect. 3.2%, just a touch softer than expectations. Seemingly saying the Fed's not going to need to worry about this, while also saying there's no crazy growth downturn that this number is implying. And yet, boy, did the markets not like it. Stocks sharply lower, dollar sharply higher, as if to say this was but a waypoint, and where we're going just needed the clearance of event risk out of our way so that we can get on with the risk-off dynamic that we were always going to pursue. And so, the question we ask ourselves today on Macro Money is, why are the markets so spooked? What is it that's so bad out here? And what is the last line of defense that maybe can forestall the reckoning? Perhaps only in the near term, but at least to some extent. So let's check in on the global business cycle first. And then we'll take a look at what is going to be some immediate event risk over these next 24 hours that finish out this week to see maybe a bit of a lifeline. The global economy isn't looking great if we consider what has been going on recently. There was a pointed and coordinated decline across manufacturing and service sector growth last year. That, of course, makes sense. Central banks have been tightening, and the sort of catch up, if you will, from COVID reopenings in the big economies, bar China, which, of course, got to this party late, only reopening as of December of last year. And we'll talk momentarily about all the issues attendant therein. But overall, the global economy seemingly driven lower by those catch-up bursts of demand around reopening in especially stimulus-heavy areas like the U.S., like the Eurozone, where consumers were given a whole bunch of fiscal support to go into lockdown but sustain spending. That seems to be now reasserting itself. There was a pop toward the end of last year as it seemed like central banks would probably see the end of their rate hike cycle within some sort of a forecastable window. And of course, a bit more spending down of that stimulus cash. Consumers had built up a lot of extra savings during the pandemic. They weren't going anywhere. They weren't really moving around as much. So a lot of the leisurely spending, a lot of the out-of-home spending didn't happen, and there was lots of fiscal stimulus. In the case of the U.S., we're talking about something on the order of 9% of GDP, not too far away from the kind of spending that the U.S. did during World War II. So there was, of course, some level of pop there, and it seemed like services were really a major catalyst toward the first half of this year. But as we can see from the global numbers, that is fading. And although manufacturing has been in contraction mode under the 50 boom-bust level that defines the way that these PMI numbers are expressed, above 50 is growth, below 50 is contraction. The further you go above, the faster the growth. The further you go under, the faster the contraction. And so while manufacturing has really been in contraction territory for a while, services are now catching up on the downside and pulling overall growth lower. This is the case certainly for developed markets, where we can see it in spades. It is also the case for emerging markets, a deceleration there. Manufacturing side for emerging markets, not quite in contraction territory yet, but essentially idling at this point. And the same sort of catch-up downward from services is pulling the overall direction, the overall composite for economic activity in those markets lower likewise. So there is, in fact, a coordinated global downturn that's underway. Let's get deeper and actually look at where that's coming from and where maybe there could be a bit of support that's left. We look at this breakdown here, and the first thing that I want to stress is how important the US, the Eurozone, and China really are, where between the three of them, just as standalone economies, we are looking at close to essentially 3/5 of global growth. And that's just standalone. Then we consider that a lot of the other economies in the world, a lot of that rest of world section, is dependent on demand from them. So if you're Australia, your main export market is China. If you're Canada, then it's the US. If you're Central Europe, then it's the Eurozone. So a ton of the rest of the pie is dependent and are essentially vendors to those three nodes. We include the UK here, though it's not a huge percentage of the whole, because we'll be talking about a bit of UK-specific data here in just a moment, so that we can get a sense of where they fit. But we can see here, these three economies, China, the Eurozone, and the US, represent what is essentially the three-legged stool of global growth. And as we'll see in just a moment, at least two of the legs appear to have been kicked out already. We'll take a brief detour to look at the Eurozone just because it's so important in this calculus, though they didn't have a tremendous amount of updates on this story this week. A smattering of Eurozone data here and there, out of Germany, out of France, but not really a major release to really power a change in the narrative. The key takeaway here is that according to the last set of July PMI numbers, the Eurozone is already in contraction. So you can see that composite index is already below the 50 mark. Now, Germany already saw its economy contract in the second quarter. Germany is, of course, the largest economy in the Eurozone. And what this seems to suggest is that as of July, that weakness is spreading. and is starting to become not just a German issue, but a regional one. So if the Eurozone is not in recession already, then it's hanging on by a thread. Then we shift gears to China. And as we've said many times before on Macro Money, the fundamental issue with China is they reopened so much later than everyone, and by then the ship had sailed. So whereas the economies of China's main export markets, its main clients, were already reopening toward the middle of 2021, the situation in China had quite a bit of catching up to do. And we only saw the reopening in December of last year. That has meant that by the time China came back, and keeping in mind that China's economy is essentially a value-add economy whereby it sucks in raw materials and inputs from one part of the world, applies its value-add capacity because of its enormous labor force, shrinking though it is now. That's a separate issue for another day. But in recent years, the model has been they apply their massive labor force onto these raw materials to add value, to either finish or semi-finish them and send them on. Of course, with the end consumers being mostly Western Europe and the US, rich world markets. In coming to the party so late, especially at a time when a lot of the supply chain was looking for opportunities to diversify, not only because COVID created all manner of chaos along the supply chain as it is, but because China was on lockdown and there was so much dependence on it that people needed to look for alternatives and had ample time to do it, that end demand for Chinese exporters wasn't there like it was before the pandemic when they came back. We saw that in spades. This is why China's recovery is really struggling at this point. With the trade data first that came out this week, it was about as abysmal as could be. We can see here staggering declines in exports and in imports along a trend that's been with us for quite some time. We can see that toward the end of last year, there was a bit of a pop in imports, a bit of a pop in exports, no longer. And as bad as expectations were, the realized results were even more negative. That we saw a double-digit decline in imports is perhaps the most eye-catching because, of course, the expectation was for something closer to 5 or 6% decline, and also because what it speaks to is not just weak export demand, but weak domestic demand as well. So if the argument was going to be that domestic demand powered by aggressive stimulus, which China is attempting, if that was going to be the saving grace, well, maybe not. We continued to see weakness when we got inflation data out of China later in the week, with clear evidence that, in fact, this issue with domestic demand isn't anything to ignore, that it isn't just that imports are down because exports are down. As we just said, China needs to import all of these input commodities to power the export engine. So you could ostensibly say, well, the reason imports are down is because exports are down. If there's no end demand, why would they import so many of the inputs to make them? Well, it's not that simple, as it turns out, because if there were, in fact, domestic demand, there would be pricing power. But there isn't, it would seem, because CPI came in negative this week, down 0.3%. This is the first time that CPI in China has been negative since the pandemic. late 2020, early 2021, is the bottom for inflation in China until this. We can also see that wholesale inflation continued to nudge into negative territory, a little bit less negative than it's been, down 4.4%, but still very, very weak and very negative. All of which suggests that there really isn't any economic vigor here. Looking at the way that Chinese economic data has performed relative to expectations, especially in the wake of the reopening, which you can see on the chart there, suggests that there's more of the same that's in the cards. So that's the Eurozone all but confirmed in recession. And that's China really struggling and effectively flirting with recession in their terms. It's, of course, more of a developing economy in terms of its growth rate. It tends to average growth rate somewhere in, let's call it, the 4 to 6 range recently, the shock of COVID notwithstanding. And so it tends to have more of this catch-up growth dynamic than the slower growth rates you typically see in developed economies, where maybe you're somewhere between 1% and 3% for Western Europe or the US. So to see the kind of weakness we're seeing in China now, yes, it's still positive growth, but by their standards, this is feeling like a recession, if it isn't one, because the numbers are negative on paper. So that's the Eurozone and China, two legs of the stool. Now, the next little bit of data that we're going to get on this is actually, as we just alluded to moments ago, coming from the UK. We're going to get second quarter GDP numbers. The expectation is that the UK economy stalled in the second quarter. That would be worse than even the somewhat pitiful 0.1% expansions in the first quarter and the fourth quarter of last year. So this is not going in the right direction either. Now, as we saw earlier, this is only 3% of global GDP, but it does tell a story. The UK is an island. It's an external-facing economy. In fact, a lot of the logic for Brexit came from, at least in part, this sense that the UK would like to become more open to global commerce without the limiting factor of having to agree these kinds of external relationships with Brussels and the European Union. So in some ways, the UK is a bellwether in this sense. So to watch it essentially stall and end up at standstill feeds into this overall narrative of a global coordinated downturn in the business cycle. In fact, UK economic data has been increasingly underperforming relative to forecasts, and so it could be that the numbers end up being even worse than standstill if we continue to see that economists' models of the UK economy are rosier even in their downbeat expectations than reality is endorsing. Which brings us to the US. Now, the latest update on this story, at least the latest catch-all update, comes from the ISM set of surveys. We got this last week. And what we see here is a familiar story. Manufacturing is in contractionary territory. These numbers work on the same logic as PMI numbers do. And of course, US PMI numbers largely tell this same tale, but they were released a little bit earlier. The ISM version is a little bit more timely, so we'll go with that one here. And What's holding up, seemingly, is services. Services, of course, the biggest part of the U.S. economy, the part that the Fed is, incidentally, so keen to cool, because that's where sticky wages are making for inflation that doesn't want to keep falling back to target. Though, of course, it's traveled a long way already. It peaked at 9 and change percent last year. We came at 3.2% today. So a ton of inflation has been squeezed out of the U.S. economy already. But the last remaining bit is this resilience in the service sector where most employment is. Not surprisingly, most U.S. growth is household consumption, as it is in most developed economies. So the service sector, employing close to 80% of the people in work, really speaks to that consumption. And in a very convenient, almost poetic way, the last bit of economic data that we are going to look at for the week is U.S. consumer confidence. And this really is that last leg. This is the lifeline. If it's a three-legged stool to global growth, and the Eurozone and China have been kicked out already, as we've seen here, then it's the U.S. consumer holding up the U.S. service sector that really stands between markets and what is a profound, coordinated global downturn. And it is perhaps this that has the market so spooked, both in the wake of CPI and in the wake of NFP last week, because, of course, this is also the place where the world's most powerful central banks' efforts are targeted, aiming to slow it down. With that in mind, the University of Michigan Consumer Confidence Survey is on tap. The expectations are that the current conditions index will generally hold little changed, a very narrow inching up expected. But the overall index, which you see in the red here, expected to be pulled down because the forward-looking expectations component is seen moving this lower. Now, we would be remiss to ignore that U.S. economic data has tended to outperform relative to forecasts, unlike the UK, unlike China, unlike the Eurozone. And so there is the possibility that actually analysts are misjudging this, that in fact we're going to get stronger consumer confidence than is expected. But then again, that would have also suggested a stronger NFP report and a stronger CPI report, neither of which went that way. So while this is the overall direction still, it need not necessarily apply to individual releases. And as we've just seen, U.S. consumers are the key separating the global economy from what could start to look like free fall. You lose the U.S. consumer and the stool falls over. So if there is any sense in this data that consumers are losing the appetite to consume, that there is a level of weakness that's starting to creep into this, well then the very fears that have so animated markets in recent days, they get amplified. And we start to see what the situation could really look like, given the sense after CPI that maybe the Fed's going to hold rates higher for longer, if not necessarily hike them again. But also that against all of this backdrop, there is now an increasingly acute risk that global growth doesn't have a leg to stand on. if U.S. consumers pack it up and go home. And so this suddenly becomes a very important release where it will be very telling to see if the number is, again, not so bad or indeed kind of Goldilocks, as NFP and CPI were. Not too hot, not too cold. Will the markets still panic, as they did after NFP and CPI? Or would they actually find a bit of solace there? If the number is relatively strong, given what U.S. data in its aggregate has been doing, will that be enough of a salve to calm investors' nerves? Does it still have that power? Or are we now in a space where the data is essentially a waypoint to get past before the markets do their thing? And is that thing now a committed liquidation drive? Because a global recession is becoming less of a hypothetical and much more of a real and present danger. We shall see. We will discuss this, of course, no doubt, on Futures Power Hour when I am there with Chris Vecchio, head of Futures and Forex here at tastylive tomorrow, as I am every Friday. We'll also get a bit of additional insight from Thomas Westwater talking about the WASD report and what's happening with global commodities in the last 15 minutes of that show. Do check that out. He's been on the forefront of calling those moves. And Macro Money will return, as it always does, next week, Monday through Thursday, right after overtime, another show that Chris and I do together where we try to make sense of the day's events and perhaps even figure out where things might be going next. I'm also opining on Twitter, yes, Twitter, at Ilya Spivak, writing for the news and insights area of tastylive.com. And as ever, I'll be on with Tom and Tony on Sunday for First Call. One last bit of programming. If you are in the San Francisco Bay Area, we are going to be here live with Tasty Live for an event this week. If you are around, do come by. The show is on Saturday morning, just outside of San Francisco here. Hope to see you there. Thanks very much. Macro Money will be back next week. Take care.